Hey guys, John Paulamy here, Actionable Intelligence. Today is Saturday, July 29th, and this is the weekly market update. The disclaimer, anything that you hear or see on this podcast or video is not to be taken as investment advice. I am not a financial planner. I cannot give you individual investment advice. Please do your own due diligence. It's your money. It's your responsibility. So I want to start this off because there was a lot of news this week in the uranium market. There's a subscriber of the newsletter that wrote me a question, and I thought it would be useful to answer it on the weekly market update, as I'm sure many people are interested in this same question. It says, longtime subscriber, and I know you are limited in what you can say. I have followed your discussion that only Cameco and Kazatomprom are investable and the juniors are burning matches. Some, such as Irwin, have recommended, that's the Sprott Physical Trust. But yesterday, Adam Smith noted that they seem to be eating up fees and not doing much else. Do you have any feeling about the Sprott Trust and URNM? They really seem to be lagging Cameco. Thanks and keep up the good work. Offshore and Cameco making me happy. So I've talked about this before with respect to the uranium stocks in the uranium situation. It's in a bull market, but it's not a lot of interest there right now, right? Sentiment and liquidity drive markets. And right now, Cameco has done very well this year. It's been one of the better performing stocks, actually. And that's because their business is turning around. It's a real company that, mines uranium, processes uranium, does things, and makes money. So obviously, with the bull market in uranium stocks, or nuclear coming back, it's going to do well, and it is. URNM is an ETF, and so it's market cap weighted, so it has a lot of Cameco and Kazatomprom in it, because those are the biggest market cap stocks. And if you go down the list, you'll see that after that, I think the Sprott Trust, the Uranium Trust, is a decent holding too. And then you start getting into the juniors, and the juniors aren't really doing anything. They've kind of been going sideways or down because there's not a lot of interest, right? Everybody was drawn to the uranium market a year ago or so, a little bit over a year ago, with visions of sugar plums, and we've talked about this before. I believe nuclear's coming back. It's in a renaissance. The business is getting better, and you just have to be patient. And if you are in the juniors, they are burning matches. If you have a company that doesn't generate any revenue, then the only way they can stay in existence is to issue shares. Now, how they use the money that they get for the shares that they issue for exploration or to advance a project, to be sold to somebody else, or to be developed into a mine, that's for each individual investor to figure out, or speculator, because what you're actually doing is speculating in those things. Then that's what you have to do. I mean, if you look at some of the companies that are going to go into production, one of them that was building a mine, we had the big coup in Niger this week, and that rocked a couple companies, because we don't know what's going to happen there. This is the risk that you take with these junior mining companies in these locations. This is part of the risk you take in resource investing. You have jurisdictional risks. Things like this happen. And a bunch of people emailed me and texted me like, what should I do? Well, if you've how do you limit your risk but still participate in the potential upside of a speculation? Well, you position size correctly. There was one tweet I saw this week, I don't remember who it was from, doesn't matter, but they said, they're really getting sick of this whole uranium thing, and if something doesn't happen this year, they've been in it for 5 or 6 years, and if something doesn't happen this year, they're out. Well, I don't know what they're talking about, because I've been in it for this long, and I have stocks that are up hundreds of %. And I think it's going to go higher over this decade. It depends. Again, we're back to the lessons that we've talked about before. And this kind of applies to offshore, which I'm going to talk about later, and some of the other things that I talk about in the newsletter. Your timing, or what price you pay to enter a security or an industry is going to be determining what your returns are. If you wait until everybody and his brother says it's time to get into uranium, then obviously you bought in the last year or two, your returns are not going to be, you're probably going to be disappointed. And so, you know, I said for the average investor, stick to the ETFs or, you know, Cameco. You know, I also said buy the Sprott Uranium Trust for physical uranium. You know, I can't tell you what the price of uranium is going to be in the future. No one can know that. I think it will go higher based on the supply demand fundamentals. And so just buying the physical uranium is a good idea, but it's correct. I mean, they're not doing anything because the uranium trust trades at a discount to net asset value. So they're not going to go out and issue more shares. They only do that when the net asset value is above, you know, positive. And so, yeah, they have fees that they have to pay. They have people that administrate the fund. They have storage fees. They have insurance fees for all the uranium they've bought. So that's what you're paying for. Now, if the uranium price doesn't do anything for the next 2 or 3 years, well, yeah, the fees are going to eat into the cash that they have. And so it just depends on what you have to determine. Two things as a speculator if you're going to speculate in uranium. Number one, the direction of uranium price, which I think most of us that are positive on uranium think it's going higher, but then the timing. When's it going to, when are these deficits that we know are there really going to matter? And so the way that you kind of protect yourself from some of these things is proper position sizing and your entry point. If you enter into a market early on before everybody else, you know, there's opportunity costs to that. You have to sit there while nothing happens potentially for 2 or 3 years, but all of a sudden things change and you get big moves. And then you have these pauses like we've been in where nothing's really happening with the price, yet the news continues to be better and better. So that's about the best I can do on this. I mean, if your risk tolerance and is lower, then sticking with Cameco is a good idea. They're going to do well during this bull market. It's a real business. They generate cash, and they're going to ride the wave of higher uranium prices. Current uranium prices and contracts they're signing are quite profitable for them, plus all the other business lines that they have. You know, but what the problem is, again, which I'll say is people want to go find that junior stock, junior resource company, you know, that's selling for 10 or 15, 20 cents. It's going to go to $10. And some of them will at the blow off top of this market, which, you know, who knows when that's going to be or if it will happen. And they want that, you know, see their, you know, 10,000 shares go to from 10 cents to $10. And that's speculation. That's just pure speculation. Now, if you position size that properly and it doesn't happen, then you really shouldn't affect your portfolio too much. But if it does go like that, then it's materially, you know, going to impact your portfolio on the upside. So I think a lot of it's around position sizing and your own view of what you're trying to accomplish on your, you know, what's appropriate for your risk, what your view is on these gets marks. I've told you what my view is. I look at a lot of these juniors that I have, or a couple that I have. I don't have a lot, but you know, I look at it as a long-term call option, and I'm comfortable with the ones I have and with the managements that they are doing the appropriate thing. And so, as long as you position size correctly, you know, things are going to happen. But if you're more risk tolerant and you just want to do it from an investment perspective, then you just buy Cameco and hold it. And it goes up 2 or 3 times or whatever it's going to do. I don't know. But that's about the best I can do on this. You know, I've talked about this before. A lot of people hear things and they just get introduced. I just saw somebody send me a message, well, I just recently came upon the uranium story. Well, your returns from this level, you know, probably won't be the same as those that got in at the ground floor before anybody wanted to even take a look at it. That's what we do at Actionable Intelligence. The same thing in offshore. Offshore is going crazy. Offshore inflection has happened. The business is recovering. The business is booming. Okay. But I bought those stocks a long time ago. As a matter of fact, the first iteration of buying them blew up in my face because we had the pandemic and there was a nascent recovery before the pandemic in offshore. that got killed by COVID, and a lot of the companies went bankrupt. So I had to sell everything, punt, and then re-enter later on. And so, it's now working. The thesis didn't change. It was just the timing. So that's what can happen. And so that's about the best I can tell you. I mean, just position size correctly. Don't go all in on any one company or any one theme, and you should be okay. Have patience. I'm sitting on a lot of cash right now because as I'm going to get into my economic discussion, I don't think that we're in a bear. I think we're in a bear market rally, and I think prices are going to go lower over time. Okay, I think we haven't seen the recession because of the lag effects that are going to come about. So I'm not 100% invested. I'm accumulating cash, and a lot of cash, as a matter of fact, as a percentage of my portfolio, and getting ready for what I think are bargains. I may be wrong. Maybe I'm going to miss the big rally. I don't know, but that doesn't mean I still don't have positions in energy stocks or uranium stocks or whatever. I do. There are things that are going up. There are things that have a positive, tailwinds that I feel will do well. And again, you can never know the future 100%. So, you have to be ready as information changes to shift your view. And that's what a lot of people don't do. We've talked about this before. This is behavioral psychology, investing psychology, which to me is totally ignored by most people. And it's one of the most detrimental factors to your success is your own psychology, how you view risk, how you manage risk, your biases. Are you aware of the biases? If you are, how do you try to eliminate them? We all have biases, okay? Most people don't even understand what their biases are, much less try to eliminate them. And these things all feed into your investing / speculating career. And so I kind of got off this a little bit, but that's kind of where I'm at. If this is working for this person, then they should just stay with what they got. But again, you have to understand about junior companies that have no revenue. How do they keep the lights on? They issue shares. Now, hopefully you've researched the companies and the management sufficiently, and they're using the proceeds from the share sales to, like I said, advance projects. They have a goal for the project to sell to somebody else or something like that, increase the resource or what have you. And if they're actually doing that, then that's positive. Again, familiarize yourself with the Lassonde curve, which is the life cycle of a junior mining company or any mining company, and how it goes through its different peaks and valleys as it discovers a property, as it tries to bring the property through different stages. And I think you'll understand more about the cyclicality of these markets. But again, people get discouraged because they buy these junior resource stocks and they're like, well, all this positive news, why aren't they going up? Because the sentiment and liquidity is not positive right now. Sentiment is horrible. Something has to happen to change the sentiment on junior resources, particularly uranium. Okay, it's just not there. There's not money flow into it because the majority of people don't get it or aren't willing to put money into it. And if you're holding those things, they are burning matches. They're not investments. They're not heirlooms. And so again, you have to be thinking about, again, the direction of the market and, the timing. And so I feel comfortable. I hold a lot of, I have, URNM. I have the Canadian one too. I can't buy it anymore, US citizens, but I bought these things very cheaply when they first came out and where they first started. And so I feel more comfortable with those again, and I have juniors and I feel comfortable. If I bought them so long ago and so cheap that the opportunity cost, I mean, I have significant gains in them and I consider that the gains will go higher. Would I sell them if I saw a better opportunity? Yes. But again, as I've said before, offshore services is my theme that I have the most conviction in. And it's second by uranium mining stocks. So it's that's just my current view. And so again, position size, like this blow up that happened in Niger this week. I mean, if you have your position sized properly, then your question is, okay, do I want to take advantage of this drop. Like evidently some newsletter writer told their subscribers to sell a particular stock. It got killed. I mean, people just probably sold at the market, and so the stock crashed. And so people have done analysis of that. Okay, what's the current market cap? What, 300 and something million now, against what's the net present value of that project in Niger? Now you have to assign some kind of risk to the government there. The French are being kicked out. That country supplies a lot of uranium to France. Are we going to see the Foreign Legion come in? Are we going to see the French government get involved? There's a coup going on. What's going to happen? It's almost impossible to game some of these things, and that's why position sizing is correct. Some people have told me they're going to go ahead and buy the shares because they feel the risk reward is skewed in their favor. Okay, that's an individual decision. I can't recommend to each individual what they should do. People have asked me, am I buying more of that particular stock? No, I already have a lot of that stock. Am I selling it? I have not sold. So that's kind of my view. Would I be inclined to buy more? Depending on the news flow. Okay, so again, it's each individual has to determine for themselves. But again, think about your risk tolerance and think about position sizing as a way to minimize risk on some of these junior resource stocks. So this is an article on LinkedIn. I put links. I try to put links to all of the articles that I reference in the weekly market update. This was a article on LinkedIn by David Rosenberg. He's a famous economist. He's a forecaster. He has a tendency, I think a lot of people think he's a perma bear, but he's really not. And so he's really been on this along with Dr. Lacey Hunt and some others, Mike Green, that we haven't seen the full effects, I think, of the potential recession that we're likely heading to. And so he wrote an article, which I thought was prescient. And I like the title of the article. It's called "It's All About the Lags." And so just a few snippets. The article's not long, so I'll put a link to it. You should read it. But here's what he says. He said, I said when the Fed first started hiking rates in March 2022, that if it inverted the Treasury curve, every Tom, Dick, and Harry economist would be telling the masses to ignore the recession message. The fact that Fed-induced curve inversions have presaged recessions 100% of the time in the past is never respected. Always a case of hope triumphing over reality. Very rarely do recessions occur in the same month as the onset of the inverted yield curve. There are lags, and that typically can be a year or longer. Think back to 2007. But like the story of the boy who cried wolf, the wolf did show up in the end. And so what I like about this article is he actually shows a chart. He puts a chart of all the recessions, when the yield curve inverted, and the time to when the recession began. So I think that's interesting. And you'll see that there is a lag effect. That's what I've been talking about. It goes on to say, like I said, it has a lot of charts in there. I would take a look at them. And like I said, it's a short article. It's like a 5-minute read. Look at what happens in the 2 years after the peak of the Fed tightening. He's referencing a chart in the article. The historical record shows that without exception, the economy slows down and does so precipitously in the 2 years that follow the end of the Fed tightening cycle. So we're not even at the end of the Fed tightening cycle. We think we're close to the end, but as Mr. Rosenberg points out, is that 2 years after the peak of the Fed tightening, the historical record shows that without exception, the economy slows down and does so precipitously. And he explains why that is. And so people are ignoring this. I'm not. Again, I assign probabilities. When I have leading economic indicators down for 15 months in a row, 14 or 15 now, I can't remember. I think it's 14 or 15. That's 100% accurate in predicting a recession. When I have the yield curve inversion, okay, and then taking into account this lag effect, which is what I had to get my head wrapped around. People are saying, well, it's all clear because it's a new era, right? I mean, AI is going to do this. It's going to make everything wonderful, just like the internet did. And it's a new era. The business cycle doesn't matter. I mean, you hear all this kind of nonsense, and the probabilities aren't that. The probability is that when you have an inverted yield curve, you're going to have a recession. When you have the LEIs down for as long as they are, that 100% leads you're going to have a recession. Now, maybe we've already had the recession. Maybe we're in it now. We don't know. But again, we've got some things that are skewed in the economy that may be holding things up. Plus the fact that the labor market continues to remain strong. We've said that. Okay, we acknowledge that. And this is, people are holding up their spending, and as long in a consumer economy, as spending holds up, people continue to spend, then likely we won't either see a deep recession or it will be mitigated. I don't believe that. I believe that with rates as high as they are, and with the Fed balance sheet running off at 100 billion a month and banks tightening lending, again, it takes time for this stuff to work its way through the economy, but it certainly will. So this is the PCE index, Personal Consumption Expenditure Price Index in the United States. It's dropped. This is something I think that the Fed takes a good look at for its measure of inflation, not necessarily the headline CPI number, but you see it's dropped to the lowest level since like March 2021 or something like this. And so you're down at 3% now. So I would suggest that we're, maybe people are saying, well, this is an indication we're heading for a soft landing. I would suggest to you that we're heading for disinflation. We do have disinflation in some areas of the economy. So again, we'll have to see what happens. This is one of the things I think that this is where some of the debate comes in around wages and employment. And just an example here is the Teamsters and UPS reach a labor deal. UPS and the Teamsters to deal on Tuesday to avert a potentially catastrophic strike, but the new 5-year contract between the two sides also threatens to keep inflation abnormally high. Under the tentative agreement, current full and part-time UPS employees represented by the union will receive a $2.75 per hour pay increase this year and $7.50 more per hour over the length of the contract. The concern now is that the pay increase included in the deal risks creating a wage price spiral in which prices march higher and workers demand additional compensation in order to keep pace. That in turn can push prices even higher as companies look to offset the steeper labor costs. Well, we'll see. But what I think is, interesting is that, UPS has to sign this, and what are they going to do to recover their costs if they want to maintain their margins? So they have to push price increases through for the delivery of packages. So that will, that consumer will pay. So again, this whole thing around employment is confusing for a lot of economists, and I'm not even an economist. And this is the thing, again, as long as the employment holds up, if you get $2-3 basically an hour and you're working a 40-hour week, but those guys work more, that's another $100-$150 a week in your paycheck, right? And again, what are you going to do with that extra 100, after taxes, 150, say you take home 100, what's the extra $100? Now you can go, to a ball game, take your wife out to dinner. People are going to spend that extra $100. That's what most people do. So again, this is just one example, but labor seems to be still tight. But I suggest again that as these lag effects work their way through the economy, they will slowly but surely. You see what's happening with prices. You've seen what's happening if you look at some of the Federal Reserve reports and some of the coincidence indicators reports that come out about how supply chain has kind of fixed itself for the most part. Prices are coming down. We know that we're in a manufacturing recession for sure, and so we'll just see what happens. But I don't. I stick with the probabilities. So this was on Zero Hedge. It says billionaire Sternlicht warns commercial real estate storm now Category 5 hurricane. So it says, days after Barry Sternlicht's Starwood Capital Group defaulted on a $212 million mortgage backed by an Atlanta office tower, Bloomberg released an eye-opening interview with the billionaire investor about mounting distress in commercial real estate. We're in a Category 5 hurricane, Sternlicht said in an interview on June 28th, taped for a July 25th release in an upcoming episode of Bloomberg Wealth. He explained that the commercial real estate downturn was sparked by the Federal Reserve's 16 months of aggressive interest rate hikes to tame inflation, and unlike past downturns, not due to reckless speculation. As we've seen in San Francisco, the inability to refinance as some properties sustain rising vacancies will pressure landlords to sell properties or walk away from them. Well, there you go. So we obviously have not seen, again, the full effect of the rate increases and the decreased liquidity. I think I read something in the article that they went out to refinance one of the properties they had. They went out to 30 some odd banks and only 2 came back with offers. So, liquidity and loans banks are clamping down. And so again, we are riding the wave of the previous stimulus, but as banks curtail lending or raise lending standards and curtail lending, become more risk averse, as the balance sheet continues to run off at 100 billion a month for the Fed, as these rate increases haven't fully made their way through the economy. As a matter of fact, this time last year, the Fed funds rate was around 2.35 or something like that, around 2.25 something. Okay, so you haven't even seen the full effects of all of the Fed funds increases make its way through the economy, and they're slowly but surely making their way through the economy. The lag effect again. So as we see these, they have a chart in this article that shows you the amount of refinancings that need to happen with commercial real estate, and it's just not, people aren't able to refinance. And again, once you have properties that get defaulted on in a downtown area or a commercial area, why do you think that the property value for the building next to it's going to hold up? I mean, this is what happens as liquidity dries up. Okay, and so the bank doesn't want, the article is pretty good because it goes into the fact that the banks don't want these buildings back. They don't want to manage these properties and mess around with it. So they're trying to figure out these deals. They're trying to restructure the loans. But in the end, if this thing, if you're a tenant, if you're somebody saying, okay, well, we're going to make an office in Atlanta, or our lease is up, and so, okay, I'm going to be wanting to go to whoever is the leasing manager for this building. I can probably get a deal on the lease because they want to get people in there, at least get some cash flow, because you have a defaulted mortgage. So the bank is holding it. They're probably going to turn it over to somebody that takes care of defaulted properties, or they have an internal staff that does that. Their job is to get some cash flow out of this. They don't just sit there and hold the line. And with all that, you have expenses in a building, right? You have to run the air conditioner. You have maintenance personnel. The electricity's got to be kept on for common areas. If you don't, things start to deteriorate. So that has a cost. And so bringing in some cash is better than no cash. And so you have and so when this starts, then if you go back and try to refinance the next building next door, be like, well, the value of this building right here that these guys defaulted on is only this. We can't refinance at these other values. All the values start deteriorating, and that's how you start creating these problems and starting to crack. Again, it's like Mount Vesuvius, the tremors, the earthquakes. Okay, we're seeing more smoke at the top of the volcano. Something's getting ready to happen. You should, rig for heavy weather or pack up your stuff and leave the area. So would I be entering commercial real estate right now? No. Will at some point it be a buy? Yes. Not now. But this is again, as liquidity tightens, this is what you start seeing. It's the whole cliche of Buffett. What he said is the tide's now going out, and we're seeing who is actually wearing swim trunks. So that's what we'll see. Here's from the St. Louis Fred. This is the chart. It's just for the last year, but it shows how the balance sheet's running off. They're not buying additional MBS or Treasury securities. Okay, they're I don't know if they're selling them, but they're letting it run off as securities come due. They don't repurchase new ones, and so that means that the market itself, market players have to purchase these securities. So what does that mean for rates? Here's a chart of the for the last back to at least 2014. German manufacturing PMI, you see where it's at. It's in a free fall. I'm not going to comment on this. I've commented on enough. I just report this news for this week. But you're getting near, you're getting near levels where we were during the pandemic, and so this shows no no indication of turning around. So this is not good. And again, where Germany goes, the whole EU goes. I thought this was interesting. Javier Blas, we haven't posted anything from him in a while. This is from the Valero, which is a big refiner here in the U.S., oil refiner. This is a comment from their CFO. It says, "We do believe that the DOE is understating gasoline demand. We're seeing gasoline sales in our system up 14% year over year and 20% from pre-pandemic levels. So at least gasoline levels are booming. I was looking at the 3-2-1 crack spread for refiners. It's around $40 a barrel. So, again, another positive for the economy. We haven't really seen fuel demand go down. We'll see what happens. And then in the context of an overall tight market, what does that tell us? I just thought this was interesting that gasoline demand's higher than it was pre-pandemic. So positive metric. The other thing, this whole idea that the DOE or different people are understating demand is a little bit concerning to my mind. But anyways, this is a pretty interesting for a mature market like the United States to have basically, this is just Valero in one area of the country. They're not in the whole country. It's Texas, Louisiana, places like that, Southwest, but things are, at least for them, going gangbusters. So this was an article on oilprice.com, and title was "Offshore Oil Stocks Flying as Investors Bet on a Deep Water Boom." You know that this is my best thesis. This thing is working. It's hitting on 16 cylinders right now. We just had results come in from a couple offshore companies that I follow. Everything's steady as she goes. Forward guidance is good. So I think next week a couple of the drillers report, so we'll be interested in seeing what they say, but especially around day rates and what they're looking at. I did see on Twitter somebody was talking about Shell or somebody, or maybe it was a smaller operator, somebody had already is negotiating for a rig that doesn't come off work until like 2026. So you have people already negotiating for rigs that are working for 2 years, or they're with another operator for 2 years, because there's such a demand for these drill ships and these semi-submersibles to drill these offshore wells or do this exploration work. There's just not enough equipment. There's not enough people. And we're seeing that now come through in the day rates and in the pricing. We're seeing backlogs grow at equipment manufacturers all across the board. And we're seeing spending going up. We're seeing final investment decisions increasing. And so what we're seeing is, I think one of the main catalysts is for a lot of the oil companies is that they understand that shale is not going to be the growth engine as it was for the last 10 years. And so now they're more, the short cycle returns that you were able to get in shale, where you could just go out and get a bunch of rigs going and start generating cash flow in 3 to 6 months. That's kind of peaked. It's not still there to a certain extent, but it's not going to be the growth engine. And so now they're having to come back and say, okay, we know where all this oil is offshore because we've already found it. Now we need to start making these commitments to these multi-year development programs and work programs that are going to be in the billions of dollars. And now I think they feel comfortable doing that. And as we see more and more final investment decisions being made, we're seeing, numbers around these projects working, below $50 a barrel, in some cases below $40 a barrel. So I think that, we haven't seen the top yet for rates and for this market, but we're definitely attracting a lot of attention to this Again, the time to buy was 2 years ago, or during the middle of the pandemic, when oil was at negative $47 a barrel, and everybody thought that that was the end of oil. But there's still upside available, but it's not it's not 10 baggy from here like it was before. Anyways, snippets from the article. Offshore drilling companies have seen their share prices jump this year as a result of renewed appetite for offshore drilling and exploration. One notable trend in ongoing offshore boom is a large increase in deep water and ultra deep water drilling. Ultra deep water production is set to continue growing at breakneck speed to account for half of all deep water production by 2030. Deepwater oil and gas production is set to increase by 60% by 2030 to contribute 8% of overall upstream production, according to a new report from Wood Mackenzie, as cited by RigZone. So there you have it. Deepwater oil and gas production is set to increase by 60% and will contribute 8% of overall upstream production. And we don't have enough equipment. And that's why you're seeing day rates go up. That's why you're seeing everybody scrambling around trying to lock in contracts. And that's why you're seeing the share prices explode upwards. Again, this is my highest conviction thesis right now. Okay, going back to bringing up copper. I'm not ready to really pull the trigger on copper, but I keep talking about this deficit situation that's developing. I think once we get back into worldwide growth, this is when the price is going to explode higher as demand increases and manifests as higher prices because supply won't be there. We've talked about this before, but again, just to reiterate from the article, simply put, the road to reaching net zero begins and ends with copper. All infrastructure built to support renewable energy uses large amounts of copper, as the metal is a highly efficient conductor of electricity and heat. According to McKinsey, global electrification is expected to increase annual copper demand to 36.6 million tons by 2031, compared to the current demand of roughly 25 million tons. However, the consultancy firm forecasts copper supply to be around 30.1 million tons, leaving a gap of 6.5 million tons by the start of next decade. So again, here we are. It's not just the renewables. The renewables are the added gasoline on the fire. It's just the needed copper production that's needed to fulfill, as India electrifies, as these other developing markets enter their S curve, they demand more and more copper for the electrification and the urbanization and industrialization of the economies. So we've talked about this many, many times. So this is coming. I think, again, you should be getting your shopping list together for what companies you want to be involved with. You've got basically a manufacturing recession in the US. I've talked about this before. The EU is definitely in recession. China is struggling. Its economy is struggling. We're still seeing the majority of countries around the world tightening liquidity. And so you still have the copper price hanging in around $3.80 a pound. I'm actually quite shocked by that. But we're seeing that across, a lot of commodities where we're not really seeing the fall in prices to, below production costs, which indicates to me that, even though maybe demand has, flatlined a little bit because of economic weakness or maybe declined in some countries, that the supply crunch and the underinvestment has led to, supply dropping faster than demand. Here's a reason why. Here's one of the reasons. Codelco, which is the Chilean national copper company, lowers copper output guidance as Chile mining woes worsen. Codelco, the world's biggest copper supplier, lowered its annual production guidance and raised cost estimates after another disappointing quarter at its mines and projects in Chile. The state-owned behemoth's output is running at the lowest in a quarter century, prices are down and costs are up, all at a time when the world needs more copper for batteries and electric grids and the shift away from fossil fuels. Second quarter production dropped 17% from a year earlier based on calculations from first half results reported by the Santiago-based firm on Friday. Well, 17% drop from a year earlier, that's pretty significant for the world's biggest copper supplier. So we'll have to, see, the problem is they've been mining copper in Chile for a long time. So again, the lowest hanging fruit was found and exploited. And so, how much money has gone into new production, new reserves? Any reserves that you find are probably going to be less, bountiful than the previous ones, right? Your head grades are going to be lower. Your development costs are going to be higher. And so, consequently, you're going to need a higher copper price to make the project worthwhile, to make the investment to go forward. And so we're seeing that around the world. So where is this 36 million tons of copper going to come from that we're going to need every year by the end of this decade, when we're only mining 25 million? So we got a big problem, and I think it will ultimately be solved by much higher prices. Again, timing is the, what's going to be the timing? I don't know. So this is a paper. This is for folks in Germany. I think this thing actually came out of Germany. You should read it. I'll just give you some of the snippets from the executive summary. But the thesis basically is that Germany can restart at least 8 nuclear reactors. They're not like totally gone where they can't be restarted. And so they should do that. The current government there is really struggling because, again, you saw manufacturing PMI is substantially below 50. It's been in recession for a while. Deindustrialization is starting to happen as manufacturers have already said they're going to start moving production offshore, a lot to the US, as a matter of fact. And so the Energiewende didn't work, isn't working. And so the solution for the CO2 emissions and for cost is to turn the reactors back on. Again, we've explained why this current coalition isn't going to do that. The Green Party, I don't say this to be pejorative, I'm just stating facts. The whole basis of the Green Party in the 70s was anti-nuclear. Atomkraft, nein danke. Nuclear power, no thank you. You can see the signs, you can look it up, you can read the history. So asking Habeck and Schultz and these people to reverse basically their entire, that's their being, right? They would have to go against their own party and the people in their party. And so the coalition would collapse. How many politicians do you think do that? They don't, that's not how it works. And so eventually what will have to happen, and which I've predicted will happen, is that the pain will become sufficient where you see like AfD, Alternative for Germany, is rising in the polls. They eventually will have an election there, and the people that are, there'll be a change in government and hopefully a change in energy policy, like Sweden. I pointed it out last week that a third of the governments now in the EU are center right or right wing, or have a big center right or right wing influence. And so you're seeing this battle going on over these ideas. And I think it will, people don't want to be poor and cold. It's just the bottom line. So once people have tasted prosperity and tasted convenience, why do they want to give that up? And so as long as elections are allowed, they probably will make changes to the people in power. So getting back to the article, which I thought was fascinating, it says Germany can restart at least 8 nuclear reactors, some within 9 months. Continuing the use of nuclear energy is supported by 67% of Germany and would stem losses in Germany's industrial production. No insurmountable hurdles have been identified. However, pragmatism and proactiveness is required. I would add one other thing: politics and policy. Okay, that's what's holding back the pragmatism and proactiveness. Okay, it's just as simple as that. German readers can, or listeners can, comment. Maybe that 67% 67% number. I don't know where they got it. I didn't go look in the footnotes to see what poll was taken. Maybe that's incorrect. Maybe it's lower. I don't know. Then it goes on, it says 67% of Germans still support nuclear energy after the closures of their power plants. Polling conducted by, you see the company here, Syve, on 11th of July, 2023, after the closure of Germany's last nuclear reactors, confirms that 2/3 of the German public support the continued use of nuclear energy to achieve the EU's climate protection goals, a share over 2 times higher than the number of opposers to nuclear energy. So there you go. So if this poll is correct and 2/3 of the people in Germany support the continued use of nuclear power, and the parties that are out of power, opposition parties, can tie the economic weakness and failure to hit the climate goals to, the parties that decided to keep nuclear power offline, then they probably will do good in the next elections. So we will see. Again, I've said before that I predict that the Germans will eventually turn at least some of these reactors back on. I've said that long ago. I stick to that. I don't know the timing, but it's inevitable because it's, you're not going to run it unless their other choice is, I shouldn't say that. It's not definitive. I think the probability is very high they will. Let me caveat that by saying, or maybe they're in a, death spiral and they are going to deindustrialize, and, maybe that, but it doesn't seem like the majority of people in Germany want that, but we shall see. So the Senate votes 96-3 to approve an amendment to the National Defense Authorization Act to establish a nuclear fuel program with the purpose of onshoring nuclear fuel production in the USA and reducing dependence on Russia for enriched uranium. Well, again, this is not a separate bill. This is part of the Defense Authorization Act. It will have to go to, there's other things in there that are politics as usual around DEI in the Defense Department and paying for transgender surgeries and stuff like that in the military, all this nonsense. So this thing will have to go and be reconciled with the House, but I think there's probably a decent chance that the defense authorization or the nuclear fuel program will move forward. So this is positive. Again, we just keep seeing more and more positive news. I think one of the Japanese reactors just came on this week that had been off for 12 years. So more and more positive news, and you just got to be patient, and you got to be holding the right securities to take advantage of the bull market. I don't think you can go wrong with Cameco, and then you can have a sprinkling of some juniors, but they should not necessarily be your main focus. So okay, that's it for this week, I think. Let's see. Yes, I had some Clown World things in here, but I didn't have time to put them in there. But yeah, that's it for this week. Appreciate the support. And again, links for the attributed articles will be in the show notes. And see you in the comments. Talk to you next week.